Hi, and welcome. And my name is Garrett Wozny. I'm an artificial skills intelligence advisor to accountants all over the world. And today, what a session we have planned. We're going to be talking about ChatGPT and advanced financial analysis for accountants. So what we're going to be exploring is that a new AI-enabled model of financial analysis that will transform static statements into strategic decision intelligence across earnings and cash and risk and optionality. And in our AI era, where calculation is commoditized, those who master this new multi-dimensional workflow will evolve from report readers into indispensable trusted business advisors. So what we're going to cover today is the different dimensions of this AI-enabled perspective. We'll look at earnings truth, liquidity and survival, capital efficiency, structural fragility, strategic optionality, and then we'll end with a financial intelligence engine that consolidates and synthesizes and integrates all those different 5 perspectives into one master prompt. And then we'll end it with some key takeaways. Let's get started. So much to cover. A bit of Here's a quick introduction. This document, it's a strategic enabled financial analysis framework. And the whole point is to elevate the financial conversation beyond traditional ratio analysis and all these different surface level metrics. The goal is to transform static financial statements into dynamic decision intelligence. And rather than focusing solely on historical ratio, I'm going to show you some structured prompts and multi-dimensional thinking to assess 5 core dimensions of financial reality: earnings truth, liquidity and survival, capital efficiency, structural fragility, and strategic optionality. And together, these lenses move analysis beyond compliance reporting and toward board-level insights. And there is intentional overlap across these dimensions. And that is not a flaw. It is a design feature. Strong financial analysis requires triangulation, right? So, and when multiple, the system is also agent agnostic. So that means even though the presentation is called ChatGPT and Advanced Financial Analysis, these prompts can be used in any of the large language models: ChatGPT, Claude, Gemini, Grok, Notebook, Perplexity, DeepSeek, JetSpark, Manus, Kimi, Qwen, or future platforms. The intelligence lies in the thinking, not the tool, right? Another element, too, is that accuracy is non-negotiable. All outputs absolutely positively have to be fact-checked within the same thread, or cross-validated through lateral movement, which means maybe you get the information in and use the prompts in ChatGPT. What you could do is you could copy the results into another model, ideally Perplexity, because of its citation-based and its accuracy and recency, for independent verification. And you want to retest against original source documents and uploads. So triangulated until consistency is achieved. Also, this framework, it's not a rigid checklist. It's a modular intelligence system. You should select the prompts and lenses and analytical dimensions that align with the situation at hand. The order is flexible. The thinking discipline is not. And also, data security and privacy are critical, important. Only enterprise-grade versions of AI platforms should be used for sensitive financial information. Enterprise environments provide stronger privacy controls, data isolation, and compliance safeguards. So public consumer tools should never be used for confidential client data. And professional judgment remains paramount. AI assists analysis, but it does not replace fiduciary responsibility. Model outputs may contain bias or incomplete reasoning. Disciplined skepticism is required. Prompts, outputs, and fact-check procedures should be achieved to preserve audit defensibility. Document which model and which version generated material analysis to maintain version control integrity. An AI-generated analysis does not constitute legal, tax, regulatory, professional advice. No AI output should be accepted without qualified human review. And above all, always double check your work, then check it again. The goal is not automation for its own sake. The goal is cognitive elevation, breaking free from ratio-only analysis and integrating earnings and quality and cash and reality and strategic optionality into one coherent decision system. This document is an invitation to think differently about financial analysis in the AI era. Let's now work through our first dimension, Our first dimension is earnings truth. Are profits real? Are profits repeatable? Are profits durable? And the core question is, if revenue stopped growing tomorrow, would earnings still hold? Okay. So now we're going to look at the first part of that earnings truth is our first prompt is earnings normalization and quality bridge. So in this case, for this example, we're going to be using Starbucks, but you can use that for your own company data or any company that you want. And here we're going to upload the data. I'll just show you what we do, the work processes. So for this, you'd go to ChatGPT, you'd upload the photos and files. So in this case, we have the Starbucks 10K. And it doesn't have to be, it could be multiple years, whatever you want. And then it's taking some time to load here. And then what you would do is you would copy and paste that prompt right into that flow. And click on that, and then good to go, and then you wait for the answer. Excellent. Okay. That said, though, I've already built them out in advance, so we're not waiting all the time for the robot to generate the answers. So for this section, for the earnings normalization or an earnings truth section, I've already uploaded the prompts, and we'll go through them one by one. Okay, so the first one, this is you're acting as a Big Four transaction advisory partner. And you want to build this normalized EBITDA bridge. And here's the executive summary. You know what? For one quick way to do, I just do that. I'll just say, hey, explain this in plain English. And it'll come back. All right, here's what's really going on. What did Starbucks actually earn? And for the quarter, Starbucks reported operating profit of almost $900 million, but EBITDA about 1.3. That's the raw number. But the number includes some unusual items, some one-time, some accounting related. What was weird this quarter is they had some restructuring changes. They closed stores and reorganized under what they called the Back to Starbucks plan. Heard about that? Yeah, they cost almost $90 million. This is technically one time, but if they keep restructuring every year. So it's not really a one-time anymore. It's like saying this kitchen renovation is non-recurring, but if you renovate every year, it's recurring. They also had a China deal where they're selling a majority stake in China retail to this company, Boyu Capital, and legal and transaction fees were about $20 million. That's generally one time. And there was a big tax spike. Their tax rate jumped like 62%. Normally it's like 25%. And that happened because of a technical accounting rule tied to China being classified as held for sale. And so here, what's the real EBITDA? And it's 1.3. Are they being aggressive? Not dramatically, but here's the honest view. The big picture, and there's the 1 cent. Okay. The point here is just the framework. We're looking at Starbucks, and we got this insight back from the robot, which is useful. But what I'm looking at is more of the bigger picture. So we got the robots to look at it. But what's going on in plain English? And we already asked that. And then a real important question I ask is, what key lessons, an accountant can take away from all this and how to analyze it in their financial statements? And great question. So here are the lessons. You want to separate business performance from accounting noise. The GAAP earnings were crushed mainly because of tax reclassification, the structuring changes, and the China held for sale accounting. So the core business, the sales, traffic, and margins tell a different story than net income. So never anchor on net income alone. Always bridge revenue with operating income and EBITDA cash flow. Then ask what's operational versus technical. Also scrutinize one-time adjustments, restructuring, and transaction costs were added back. But ask, is this truly non-recurring? And just because management calls something non-GAAP doesn't make it non-economic. Recurring one-time charges reduce quality of earnings. And watch for accounting classification effects. China was classified as held for sale, which stopped depreciation. So the lesson is classification changes, held for sale, reinvestment, lease treatment can materially move earnings without changing business reality. So always ask, did customer behavior change or did just the accounting presentation? Okay, that's the first one. That was the earnings normalization and quality bridge. Beautiful. Okay, let's go to the second one, where we're asking it to look at the revenue durability and recurrence analysis, where we act as a valuation advisory specialist. There we go. And here's the analysis that it came back with. And we'll just say, explain this in plain English. What's going on in Starbucks line? And here, the core question was, how strong, how dependable is Starbucks revenue? And where did the money actually come from? They made about $10 billion last quarter. Most of it comes from people buying drinks and food in their company-owned stores, and then royalties from their licensed stores. And 5% grocery and ready-to-drink partnerships, like bottled Frappuccinos. Wow. And is this revenue stable or fragile? The good news, Starbucks has over 40,000 stores worldwide. It's incredible. And sales in existing stores grew 4% globally. So do they depend on one big customer? No. They sell to millions of individual customers. And what are the real risks is that North America makes up about 3/4 of revenue. That's concentration risk. So how durable is it? If we strip out the jargon, Starbucks revenue is highly repeat-driven, very diversified, mostly habitual. On a durability scale, it's like 8 out of 10. Okay, that's interesting, that analysis. But what are the lessons that we can learn from that as accountants, as financial advisors? And here are 3 short. So don't just look at revenue. Look at revenue quality. Not all revenue is equal. Is it repeat behavior, like Starbucks Daily Coffee? Is it contract-based, like the licensing royalties? Is it one-time or project-based? A company with recurring, repeat, diversified revenue generates more confidence and often a higher valuation multiple than when dependent on one-off sales. Good. Analyze concentration by geography. Analyze concentration by segment. Analyze concentration by customer. Starbucks isn't dependent on one customer. That's great. But almost 75% of its revenue comes from North America. So accountants should always, is revenue concentrated in one region, one product line, one major client? That's a regulatory environment. Revenue concentration hides in segments, not just in customer lists. And also look at cash signals, not just earnings. Starbucks generated strong operating cash flow and carries billions of deferred revenue. That tells you customers prepay, cash generation is real, and the business has forward visibility. Lesson is cash flow and deferred revenue often tell you more about durability than EPS. Okay, so there is our second dimension of advanced financial analysis. Okay, let's go to the third one. This one is the margin sustainability diagnostic, where we want to act as a performance analytics strategist. There we go. And we'll do that same prompt again. We'll just say, explain this in plain English. Explain this in plain English. So it goes through all those statements. Oh, here's the plain English version. No financial jargon. Big picture, Starbucks is selling more coffee again. Revenue's up. Customer traffic is up. Sales are growing. But profits are shrinking. Why? Because costs are rising faster than sales. What's going on? They're spending more on labor. There's higher costs for coffee. North America's a problem. It's their biggest profit engine. And their margins dropped from 17 to 12. That's a big decline. International looks better. And their cash-like earnings are also down too. So are margins stabilizing? Not yet. The plain truth is that Starbucks shows growth of margins. If they're betting if we win back customers, profits will follow. That's good. Let's just see what are the lessons accountants could take from all this. Is that revenue growth means nothing without margin context. Sales were up, traffic is up, yet operating income fell sharply. So always analyze the growth alongside operating margin. If expenses grow faster than revenue, the business is actually weakening, even if the top line looks strong. Separate structural problems from temporary noise. Some margin decline came from real cost pressure like labor and some improvement came from accounting challenges because of that China depreciation stop. So don't stop at GAAP versus non-GAAP. Ask, is this cost recurring? Is this accounting driven? Is this strategic? Strong analysis distinguishes permanent shifts versus temporary distortion. And watch operating leverage like a hawk. Revenue was up 5 to 6%, but operating income was down almost 20%. That's negative operating leverage. So operating leverage tells you more about the business quality than revenue growth does. When costs are becoming more fixed or structurally higher, future profit requires pricing power or productivity gains. So, right, be in short, growth can hide weakness, accounting can hide reality, and leverage reveals truth. That's the accounting edge. Okay, next, we're going to act as a forensic data analyst here. We're going to compare what the management said versus to the financial performance trends. And here's the main narrative. But let's just jump ahead. Explain in plain English what's going on here. And all right, plain English, what's really going on? What management is saying, they're saying customers are coming back. That's great. They have that turnaround plan. Back to Starbucks is working. They're ahead of schedule. That's the story. But the numbers say maybe not complete alignment. Store sales are up. That part is real. But profits is that their operating margin dropped sharply. So sales improved, but profitability got worse. And this is where the spin happens, is that they focus on sales growth, but they downplay that costs rose faster than sales and labor and coffee costs increased. And that international profits look better. And they're still paying dividends, 0.62 per share, but earnings are down heavily. So they paid out over $700 million in dividends in the quarter while earning only $293 million. That's a signaling choice. We're stable, but financially profits aren't covering dividends right now. What this really means is not a fraud story. It's not a disaster. It's that customers are returning. The turnaround might be working, but profitability hasn't recovered yet. So the bottom line in one sentence, sales momentum is improving, but earning strength hasn't caught up yet. Management is optimistic. The numbers are cautious, and that gap is in attention. Okay, what are the lessons we can learn from this? We'll click on that one as well. So, and this exercise that we're doing here, going through these different dimensions of advanced financial analysis, you might want to experiment. You can use your own, of course, you can use your own company, but just look at other public companies or other organizations that you have earned revenue on, and just to get in this habit to have this, to develop this muscle of how to look at these reports from these different perspectives. And here are the sharp lessons. Revenue recovery does not necessarily mean profit recovery. Sales can improve while profitability worsens. In this case, the lesson is always move past revenue headlines. Track operating margin, cost ratios, and top-line growth without margin stability is incomplete recovery. Non-GAAP adjustments change the story, but don't ignore GAAP. The lesson is understand what's being excluded. Restructuring, transaction costs, tax reclassifications. Are these truly one time, or are they part of an ongoing strategy? And follow the cash, not the narrative. I love that. Dividends paid were more than quarterly earnings. So margins contracted, debt remains high, yet the narrative is confident. Lesson cash flow, capital allocation, balance sheet strength often tells a quieter and more honest story. So the bottom line for accounts here is when analyzing financial statements, look beyond revenue, reconcile the GAAP and non-GAAP carefully, and always follow the cash. The discipline separates surface reading from professional analysis. Okay, good. And in the final section, we're going to look at forecast accuracy. We're going to act as an AI governance and behavioral finance analyst. And where are we here? Yeah, perfect. So here is that listing that they'll have, and we'll just say explain in plain English. And it'll come back here. All right, you asked, are Starbucks forecasts habitually too optimistic? Do they systematically understate problems? Here's a simple breakdown. Are they overly optimistic? Not wildly, but yes. And what pattern shows up? Here's a recurring pattern. Sales improve, margins drop. What about the tax shock? This quarter GAAP earnings dropped 62%. That sounds dramatic, but most of it came from an accounting reclassification tied to the China joint venture. So what's the real risk? It's not fraud, not aggressive accounting, but the risk is slower than promised margin recovery. And what would better governance look like? In plain English, stop calling recurring costs one time. So in this case, the Starbucks forecasts are moderately optimistic, adjustment friendly, strategically framed, but not reckless. And then here we're just going to put in what are key lessons that accountant could take away from all this. And we'll put that there. Here are 3 quick practical lessons that accountant could apply immediately when analyzing financial statements. Always compare GAAP versus adjusted and ask why. If GAAP earnings and adjusted earnings are very different, just don't accept the adjusted number. Ask, hey, what's being included? Has this one-time item happened before? Could it happen again? Number 2, watch the margin, not just the sales. What does it really matter? So are the margins expanding or shrinking? Sales without margin strength is fragile growth. And follow the incentives. Understand what management is paid to hit. Is it revenue targets? Is it operating income? People optimize for what they're measured on. Ain't that the truth? So if bonuses are tied to adjusted metrics, expect heavy emphasis on adjusted reporting. So look past the headlines, reconcile the adjustments, track recurring temporary costs. That's how you move from reading financial statements to actually analyzing them. And speaking of analyzing them, I should also note as well that you have the option. Well, here's something, we just don't have time to go through these in because there's all these different frameworks I want to look at. But one thing you absolutely want to do every time when you're talking to the robot is to just to say, hey, just fact check. Is this true? Okay, so that should be a core step in every one. Yes, the broad points are true and grounded in financial standard, but here is a clear fact of each one. Always compare and contrast, summarize in plain English. Right. So that should be a best practice, just because I want to get through all these different frameworks here as quickly as possible. But you want to include that fact check. Is this true? Every time you talk to the robot, every time you get an output from the robot, you want to push back and say, okay, is this correct or not? Can you give me an update on that? And robots, especially ChatGPT, they're very honest. They'll say, okay, this is correct. This is verified. Or this is navigationally aligned, but there could be some room for interpretation, and here's what you need to look at. Another element, too, is that you could go under like Perplexity, and then from there, you could upload the same financial statements that we did with ChatGPT. That's going to upload here. And then what you could do here is just take that whole sequence. Where are we here? Took everything that the robot said. Here, we'll copy everything over. Perfect. And then we'll put it into Perplexity. And then we'll ask, hey, is this true? Again, I don't have time. We don't have time to do it for every one of these because of just the limitations here. But this is really a best practice with any set of financial analysis. It's not just going to ChatGPT, but you could ask ChatGPT for a fact check, but then also go to Perplexity to get that second opinion. And the reason Perplexity is really good because it's grounded in truth. They have all these citations, and they focus in on accuracy and recency. Whereas ChatGPT, it's great at creativity and fluency. So sometimes ChatGPT will, not sometimes, most of the time it'll hallucinate. It'll sometimes make stuff up. So you can pursue that. And another element too, there's nothing stopping you from doing this analysis, feeding these same prompts, put them into Perplexity as opposed to ChatGPT, and you could compare them. And here, the provided summary are accurate and well-grounded in the official document analysis and accuracy. Okay, that's good. That's a good thing. You want to do that. So that's one way to check the results. Go on to ChatGPT. If it's generated an output, copy and paste that, put it into Perplexity. Okay, and just one other final thing as well is that you can also build out all these graphics to these different outputs that we've created here. Okay, first of all, you could go to Claude. They have a tool called Artifacts, which is really good. And yeah, there it is, Cloud Artifacts. And click on Artifacts. And then take all that context that we got from that prompt or just that output, that sequence, that thread that we got from ChatGPT, and put that into Claude.ai, and then click on Start from Scratch, and then put in that context here. And then here, just give it a very simple command, but it's really powerful. It'll work. You could just say, hey, we'll skip this. Create an interactive dashboard, mini site, or simulation. I'll click on that. So it'll build that out. Okay, while that's being built out, and first of all, it'll just say, here's the plan. We want a multi-tab interactive experience. It's building it now. Okay, sometimes it will come up with a plan and then ask you, is this okay or not? In this case, it's just going ahead to build it, which is great. And we'll wait a few minutes here for this to build out. And then you could also, another great one too is Gemini. Gemini is great. They have a tool called Canvas. You know, ChatGPT, they have their own version of Canvas as well, but it's more text, a text for inline editing. Whereas Canvas in Gemini, it's actually both. You can do inline editing for text, but when you say Canvas, it's almost like an app canvas as well. So what we're going to do here is we're going to go to that output that we got from ChatGPT, and we're going to put that into Gemini. Boom, there it is again. And then we're going to give it that command, that same command, which is really simple. Create an interactive dashboard, mini site, or simulation. Okay, there we go. And we'll put that over here. And we'll click on that, and it will build out a simulation here. And have the coding right here in the background. That's incredible. Whereas before, right, if you were to do any kind of data visualization or any kind of graphic, you'd go to Excel, you do a pie chart, line chart, bar chart, similar. But now you could go on to Gemini, you can go on to Claude and just feed in that context and just say something really, really simple. Hey, build this out as an interactive dashboard or a mini site or simulation. And you just wait for a few minutes for it to bake. So here, this could take some time, so don't expect it. But they are getting faster. I remember, let's say, when this first capability came out, you'd have to wait 10, 15 minutes. Now, not nearly as long, but still, if you want those instant answers, it could be frustrating. I find that Gemini, for the most part, is way faster than Claude. Yeah, well, here's Claude. And here is that. So we gave it that context about AI governance. And look what it came back with. This is really cool. Amazing. And they'll have the gap versus adjusted, segments, the governance, the analyst lessons. The point of this is something that you can add in too, right? With that advanced financial analysis, it's not just the text narrative, is that you could build this out as different infographics using, this is Claude. And then the great thing about this is that you can publish this and copy the link. And then there's a link there. I should note as well that in all these different tools that I'm looking at here, ChatGPT, Gemini, Claude, I'm using the enterprise versions of them, right? And you should too. If you want to use any of these tools here, you don't want to be putting confidential information into free tools. You don't want to do that. What you do want to do is have the enterprise versions. They have a higher level of security, privacy, and compliance. For the most part, your data is not used for training, and they meet the higher standards of these different international security protocols like the General Data Protection Regulation, the California Consumer Privacy Act, the Cloud Security Alliance, Systems and Organizational Control Type 2. All these regulatory regimes, they will meet and satisfy. So that's best practices. So that's another tip. It's not just getting that narrative, but you can have these incredibly persuasive, visually impactful analysis that bear that out. Okay, so this is Claude, and then here we published it, and this is what it looks like. So when you share it with somebody, you'll get that. You'll get a full screen experience here. And so you can share it with whoever you want here. That's cool. On there. Okay. And then we look at Gemini. It's still building it out here. So that could take a little bit of time. Again, depending on how much complex or how much information you throw out, it could take a little bit more time. And then here is a lesson. But the point being is just with that workflow that we talked about is go to the handout, right? Upload your financial statements for your company, like we did, and then put in the prompts. And then the workflow was put in the prompt, and then we just said, explain it in plain English. And you got the summary of that. And then after we said, what are the key lessons an accountant could take away from this? And 3 quick bullets. And it has these larger, big picture perspectives, and those are very valuable. And then we ended it up too, where if you wanted to, you could build out and create these different types of narratives or these mini websites and simulations. I mean, this was impossible, a year ago, but now it's so easy to create these different artifacts from scratch. So that is our first dimension of advanced financial analysis. Let's now move on to the second dimension of our framework. And in this case, we're going to look at liquidity and survival. Can the company withstand stress? How long can this company survive under pressure? Okay, the first one here, we'll look at the rolling liquidity visibility analysis. And here we're going to act as a restructuring CFO. And we'll just pull it up here. I've already done that prompt in advance. I've uploaded the documents. I've given it the prompt. And then we've said act as a restructuring CFO using the updated financial statements, construct a rolling forward cash flow view, evaluate operating cash generation, working capital demands, and debt service obligations, provide a survival horizon assessment under current operating conditions. Okay. And it comes back with the details. I'm just going to jump ahead here and just say, okay, explain all this in plain English. And in plain English, do they have enough cash? Yeah, they have $3.4 billion in cash on hand. Are they still generating cash? Yes, and lots of it. What do they have to pay each year? Interest on debt, store investments, dividends to shareholders. And is there a cliff coming? No immediate danger. They do have about 1.58 of debt due within a year. What could cause trouble? A big drop in sales, refusing to cut dividends. The bottom line is they're not in financial distress. They're not running out of money. They're highly leveraged but stable. Okay, so what are some practical lessons from this that an accountant can take away from all this? Is that cash flow tells the truth, not net income. The net income, that dropped sharply this quarter, but operating cash flow was still strong. So the lesson is always check that cash flow statement. Earnings can swing due to tax adjustments or restructuring changes or accounting classifications, and cash generation shows whether that business engine whether or not is it actually working. Liquidity does not necessarily equal profitability. Margins compressed, earnings fell, and the company still has over $3 billion in cash and continues to generate billions annually. So the lesson is a company can look weaker on the income statement and still be financially stable. So you want to separate operating performance from liquidity positions. They're not the same thing. And then follow the fixed commitments, debt, lease payments, dividends. They're the real pressure points. The dividend alone is nearly $38 billion per year. So the lesson when analyzing financials asks, what must be paid no matter what? What can management control or cut? Financial flexibility often matters more than reported earnings. Right? Cash first, liquidity separate from profit, and focus on fixed commitments. Okay, let's look at the debt service capacity. I'm going to just shut this window down here. And we're going to scroll to the top. And here we want to ask it, act as a senior commercial credit officer and analyze the company's debt structure, interest burden, and amortization profile. Identify covenant headroom and breach risk under stress assumptions and provide a structured credit risk assessment. So if you're looking to get a loan, this is a prompt that you would use. And it comes back with that analysis listed here, but we asked it, hey, just explain this in plain English. And how much debt does Starbucks have? 16 billion. So net debt is about 12.5. Could they afford the interest? Yes. How heavy is the debt compared to earnings? 2.4 annual earnings. Do they face near payment pressure? No. What is the real credit risk? Not debt default. The real risks are margin pressure. And the bottom line is they have meaningful debt, but it generates far more cash than it needs to service it. Okay, that's good. But what can the Starbucks situation, how could we apply that to our own work? Just don't look at net income. Follow the cash. GAAP earnings can swing, but debt gets paid with cash. So compare operating cash flow to interest expense. Compare operating cash flow to debt maturities. Could this company pay its debt from operations alone? Always stress test the numbers. Never analyze one scenario. Ask what happens if earnings fall 15%? What if rates rise? And separate the structural risk from the noise. Not all scary numbers are dangerous. Example, negative book equity does not equal bankruptcy risk. Focus in on recurring earnings power, leverage relative to cash generation, and liquidity versus near-time obligations. In short, strength is measured by resilience, not perfection. And just as we did in the first sequence, you want to do that fact check. So you could just say, fact check everything in this thread. In this thread. Is this true? And we'll see what it comes up with here. So it's thinking, searching the web, what is true and verified, what is not verified or not supported by the public release. Were inferred, but I could not locate those specific numbers in the public press release file online. I could not confirm the debt figure. I could not confirm. Okay, that's good. I mean, for this illustrative purposes, we're not going to have all the information there on hand. But the point here, at least the robot has pointed out, this is what I know, and this is what is not verified or not supported. Ideally, when you are talking to the robot and you give it that prompt and you get the answer back, you're asking it, okay, can you verify this, yes or no? And if not, you want to say, okay, what else do you need from me to ensure that everything that I share with you is verified? So here it comes back, the confirmed guidance verified by public filings. Conclusion, Starbucks did report earnings. To fully confirm on, we'd need a full quarterly Form 10Q and financial statements. Okay, but I mean, there it fills in the gap, says, okay, this is what we would need to move forward. And this is for illustrative purposes, just to show you how this is done. And when you are using your own numbers, you want to make sure that it's locked down, everything in there is complete. If there's anything missing, you could give it to the robot. Okay, that's it. Let's create some graphics now again, just like we did before. So you take the whole copy here, and then you could go to Gemini, and then go to Canvas, and click on that, earnings power, and then say, create an interactive dashboard mini-site or simulation on here. And that'll do that. So click on that and it will get rolling. Developing the credit risk dashboard. Beautiful. So this could take but you want to make sure that that canvas is generated as well. Okay, so we did that one. We did the act as a senior commercial risk officer. Okay, we'll click on that. And now we're going to go on to the third element in our liquidity. We're going to look at working capital and act as an operational finance transformation consultant. Right, this is part of our work process, our 5-star model here, and it came back with the results. Good to know. Let's just jump ahead, explain in English what's going on. Working capital is basically the cash tied up in money customers owe you, inventory sitting in warehouses, and bills you haven't paid yet. What does this mean? Inventory is high, and you have to pay suppliers faster. Good. What lessons did we learn from this? Is that just don't look at profit, follow the cash. Net income could fall or rise for many different reasons. Tax, restructuring, one-time items, but what matters operationally is cash from operations strong. Always reconcile earnings to operating cash flow and examine working capital changes. Also, working capital tells you about operational health. Small balance sheet shifts can reveal big stories. Inventory rising, great. Demand issues or supply chain buffering. Payables shrinking, loss of supplier leverage. Receivables stable, pricing power intact. So you want to analyze trends in accounts receivable, inventory, and accounts payable to understand operational discipline, not just accounting results. And you want to separate temporary noise from structural signals. Is this a one-time event or is this a pattern? The key is distinguishing timing events from structural trends. These are the real financial judgment lives. Perfect. Let's go to the third one, refinancing. We want to act as a corporate finance advisor. And we'll go up to the top here. Yeah, perfect. And it came out with the report, which is great. We asked it for the explain in plain English. What's the situation? They have like $16 billion debt. Can they afford the debt? Yes, for now. What's the real risk? Is that can they play today? Yes. But when old, cheap debt matures, they'll likely have to refinance at higher interest rates. Is there a cliff coming? What do they say here? Not right now, but maybe down the road. So what does all this mean from you, right? You want to go through that analysis, but always look beyond net income. Earnings can swing. Ask, is operating cash flow stable? Cash pays debt, not just adjusted EPS. Analyze coverage and leverage together. Just don't look at total debt. Look at interest coverage, net debt to EBITDA. And watch maturity timing, not just amount. Refinancing risk is about the total debt. It's about when it comes due. How much matures within 12 months? Does cash cover near-term obligations? You want to have a well-laddered maturity schedule. That reduces the cliff risk. So when reviewing any company, look at liquidity, look at earnings durability, and look at debt timing, that maturity ladder. Master those, and you'll see risk before the headlines do. Okay. We'll click on that one. And then the final one is we're going to click on the downside scenario and resilience simulation. We're going to act as a risk analytics specialist. We want to model downside scenarios, including revenue contraction, margin compression, and present findings in a board-ready risk summary format. And just confirm that. All right, and there's the downside risk analysis. And here's the key observations. And then we'll just scroll down to, explain what does all this mean in plain English. Is that it makes about $10 billion per quarter. That's incredible. Still profitable. It has over $1 billion in cash on hand, but it also carries a lot of debt and lease obligations. It's healthy, but more sensitive to shocks than it used to be. What happens if things go bad? There could be a mild slowdown. Let's say the recession, or there's a real recession, or there's a severe shock. They would survive, but only by pulling emergency levers. So what's the bottom line? Starbucks is not fragile, but they're not bulletproof. They're more sensitive to margin compression than revenue decline. So what are the lessons here? Is just don't look at revenue, watch the margin. Sales can go up, things can still get worse. The lesson is margins tell you how resilient the business really is. Revenue is vanity, margin is survival. And cash flow matters in net income. Net income dropped sharply, but the company still generated over $1.7 billion in operating cash flow. Lesson, always trace earnings to cash to debt obligations. Profit doesn't pay the bills, cash does. And balance sheet risk is often hidden. Starbucks has strong brand power, but also over $16 billion in debt, over $9 billion in lease liabilities, and they have that shareholders deficit. That's negative equity. So that leverage amplifies risk if margins fall. Lesson is always assess debt levels, fixed obligations, and cushion before covenant or liquidity stress. Income statement tells you how you're doing, but balance sheet tells you how much pain you can take. This is one way to stress test the business. And now let's go back to Gemini, and here's that credit risk analysis that we had it generate for us. That's amazing. And that's another type of tool that you can have and use. Get the robot to generate not just the narrative, but the different tools listed here. And they have this stress test simulator here, and how that'll change between the base case and the severe downside there. And some of these here, let's just share these here. So right now, it's it's built within Gemini, but if you wanted to, you could make it public. You could create a link, click on the link, copy the link, beautiful. And then we'll go to Gemini, and then we'll click on that, and then we'll hit enter there. And then this is what it looks like in the big screen, right? So you should do, you must do that as well. That's the power of ChatGPT and Gemini, is that not only you can build out that narrative, you can create this really visually appealing, in this case, credit risk analysis for enhancing and improving the persuasion and elevating your data story capabilities. Let's go to the third dimension of our framework. And here we're going to be looking at capital efficiency. Is every dollar deployed, is it generating economic return above its cost? Let's find out. Let's go to Starbucks. So in this first one, we'll look at return on invested capital decomposition. And for the prompt here, we'll ask it to act as a corporate finance strategist and decompose return on invested capital into operating margin and capital turnover components and provide a capital redeployment recommendation framework. Beautiful. Okay, so we ran that prompt. We uploaded the documents that it came back with the text. And now let's just go straight to the explain in plain English. And what it means is that return on investment capital answers one question. For every dollar Starbucks put into its business, how much profit did it generate? And roughly speaking, Starbucks earns about $14 for every $100 invested. Is that good? Yeah, because their cost of capital, what it costs to borrow the money, is about 8%. So they'll earn around 14%, and it costs them 8%. That they're creating about 6% extra value. That's good. But here's the important part. That 14% return comes from two things: operating margin, how much profit they make on each dollar of sales, and capital efficiency, how much sales they generate from the assets they're invested in. So margin is, think how fat the slice is, and turnover is how many slices they sell. And here they're talking about what's happening right now. North American margins are falling because labor, amongst other things, is costing more. Stores are capital heavy. They have almost like $8 billion in physical stores and equipment. It's a lot of money tied up to operate locations. And then they have a hidden superstar. They have this channel development, grocery store, coffee, bottled drinks partnership that has a 41% operating margin. And that's a key economic engine. Okay, so what's the lesson from all this is that don't stop at earnings, analyze return on capital. Net income can look fine, but the real question is how much profit is generated for every dollar invested? Always connect operating profit with balance sheet capital, cost of capital. Margin trends matter more than growth headlines. Revenue growth doesn't guarantee strength. Look out for operating margin direction, the cost structure shifts, the segment level margin changes. Right? A shrinking margin in a capital-heavy business is an early warning sign. And segment analysis reveals the real story. Not all revenue is equal. High-margin, asset-light segments versus low-margin, capital-intensive segments. Capital should flow to businesses generating the highest returns, not necessarily the biggest revenue. So look beyond the income statement, connect profit to capital. Follow the return, not just the revenue. Okay. Let's go to the second one in our capital efficiency. Let's look at economic value creation analysis. Okay, and in here, we're going to act as a performance management specialist. There we go. So we ran it by the numbers with Starbucks, and it came back with the explanation, what is economic profit? Think of it like this. Starbucks doesn't just need money to make money. It needs to make enough money to justify the debt it has borrowed, the stores it has built, the leases it has signed, the capital investors have committed. So that's required return is the cost of capital. So if Starbucks earns more than the required return, it's creating shareholder value. And if it earns less, it's destroying shareholder value. And is Starbucks creating or destroying? Short answer, it's still creating value, but much less than last year. And why did value creation sink? Not because sales collapsed, because the problem is profit margin. Costs for labor, coffee are up, tariffs and inflation, restructuring costs, operating margin fell from about 12 to 9%. What's the lesson from all this? is that profit does not necessarily equal value creation. Just because a company reports net income doesn't mean it's creating shareholder value. You must ask, is the return on capital higher than the cost of capital? Is the spread widening or shrinking? And Starbucks is profitable, but value creation compressed because margins fell relative to the capital base. So always evaluate performance relative to the invested capital, not just the earnings. Movement matters more than revenue growth. Revenue grew, traffic improved, stores expanded, but operating margin dropped from 12 to 9%. That margin shift drove most of the value compression. The lesson is that small percentage changes in margin can dramatically change economic profit. So always track margin trend, not just top line growth. Another one, too, is capital structure amplifies outcomes. Starbucks has heavy debt and lease obligations, and when profits are strong, the leverage boosts returns, but when margins compress, the leverage magnifies pressure. So always analyze earnings in the context of balance sheet risk. Income statement performance cannot be interpreted in isolation. So if I had to compress this all in one line, smart accountants just don't read financial statements. They read the relationship between profit, capital, and risk. Okay, let's go to the third one in our capital efficiency, and this is capital allocation. Act as a long-term institutional investor. Review historical capital deployment decisions, including acquisitions, fleet expansions, and debt issuance. Provide a capital allocation discipline assessment with supporting evidence. Okay, so we got the results listed there. Let's just go straight to explain in plain English. And in plain English, Starbucks, they're still opening new stores, 128 new in the latest quarter, and they're guiding to over 600 in this year alone. But they're also closing weaker locations and restructuring. So what this means is that they're not blindly expanding. They're trying to improve store productivity instead of just chasing growth. Their China joint venture, they're selling up to 60% of their China retail business to provide to a private equity partner, but keeping 40%. So they're taking some money off the table in China, but while still staying involved. And they're not not doing this by big splashy acquisitions. There's no expensive buying spree, no massive goodwill expansion. And then they're going to pay over $700 million in dividends just this quarter. And they paid dividends for over 60 straight quarters. So they're responsible shareholder returns. So what does this mean? The big picture is that this does not look like a company being careless with capital. It looks like a company that is resetting operations, avoiding emergency buybacks, and avoiding empire-building acquisitions. The only risk is that North America margins need to recover. Are they reckless? No. Are they disciplined? Yes. Okay, what lessons can we take from all this? Always separate real performance from accounting noise. GAAP earnings dropped sharply, but much of it was driven by restructuring, transaction, and class reclassification. So don't react to headline EPS. Reconcile GAAP to adjusted numbers and ask, hey, is this recurring or temporary? Good analysts isolate core operating trends from one-time distortions. Follow the cash, not just the income statement. Operating income fell, but operating cash flow was still strong. So cash flow tells you durability. If cash generation covers dividend and investment needs, the business has resilience even when margins dip. And then finally here, capital allocation tells you management quality. The real story wasn't just earnings, it was selling part of that China because it reduced risk and not overdoing the buybacks. So study how management deploys capital. Are they empire building? Are they recycling capital intelligently? Financial statements aren't just numbers. They reveal decision making. Okay. Now let's look at asset productivity. And in this case, we're going to use the model to act as an operational performance advisor. And we're going to analyze different asset turnover trends, fleet utilization rates, and capital intensity metrics. We want to recommend rationalization, divestiture, or redeployment strategies. And here it comes back with the analysis. And then we're going to explain it in plain English from Starbucks' point of view. Are Starbucks assets working hard enough? And here they have about $32 billion in assets. They generate about $10 billion in sales. That's fine, but the problem is in sales. Its profit per store is falling in the United States. So the stores, they're busy again, but they're not as profitable as before. And the assets look weak. The weakest area is North America. Sales up slightly, profit down sharply. So some of the stores clearly are expensive to run, and the international stores look healthier. So the underperformers are likely older U.S. stores in high-cost urban locations. What should they do? Close the worst-performing stores, shut down the bottom few percentage that aren't covering the cost, shift money to stronger areas like drive-through locations or grocery ready-to-drink business, and then lighten the balance sheet. That they did that China joint venture move. So it's not, the real story is that this isn't a crisis per se, it's a return discipline moment. And then what are key lessons that accountant can take away from all this? Is that don't judge performance by one number. Earnings dropped 62%, but that was mostly due to a one-time tax accounting event. So always ask, is this an operational weakness or an accounting distortion? Normalize for unusual items. Follow the margin, not just the revenue. Sales went up, but U.S. profits fell sharply. Right? The revenue shows demand, but margins show discipline and efficiency. And if margins are shrinking, something operational is changing. And also use cash flow as your truth serum. Net income looked messy, but cash flow was still strong. Right? When earnings look volatile, go to the cash flow statement. Cash tells you whether the business is fundamentally healthy. If you consistently adjust for one-offs or analyze margins by segment or confirm with cash flow, you'll analyze like a senior financial professional, not just a headline reader. Okay, and then the final one in this section, we're going to look at the cost structure, leverage and operating elasticity modeling. We want you to act as a strategic cost analytics consultant and classify expenses to fixed, semi-variable, and variable components. And yeah, there it is, perfect. And there it did that response. And then we're going to come back with explain all this in plain English. Again, this model, it's meant, you don't have to go every single one in that exact same order. You can pick and choose which one works best for you. But I'm going through them in detail like this just to show you that, while there is some overlap in the analysis, the point here is there is that central theme. These are one of the incredible power capabilities of AI is that you can throw in these prompts, upload those financial statements, and then just get those kind of insights back immediately. Whereas before, you may have not even just known to ask those questions, or they may have taken more time with Excel spreadsheets to have to know these complicated formulas. But now it's just plug and play, drag and drop, copy over the prompt into a ChatGPT, and then you'll get those responses back. Okay, so explain in plain English. What kind of costs does Starbucks have? Variable costs, coffee, milk, cups, shipping. If they sell more drinks, these costs go up. If they sell fewer drinks, these costs go down. These costs go down. Semi-variable costs that are partly fixed, partly flexible. Employees, utilities, some operating expenses. And then they have fixed costs that don't move much at all. Head office, corporate overhead, rent commitments, debt interest. These are rigid parts of the business. Why does this matter? Because Starbucks has what's called operating leverage. If sales go up 3%, a lot of that extra money drops straight into profit. If sales go down 3%, profit drops much faster than sales because fixed costs don't shrink. It's like a seesaw. When sales are rising, leverage works in their favor. When sales slow, leverage works against them. What's working against them is they got lots of leases. They have over billions in long-term lease commitments, and they just can't turn those off. They've recently invested more in labor, so if traffic slows, these wages don't instantly disappear. And they also carry significant long-term debt. Okay, so what's the lesson from all this? Is that always separate fixed versus variable costs. Don't just look at total expenses. Ask, hey, if revenue moved 5%, what actually moves with it? And understanding which costs are flexible, your coffee materials, and which are rigid, leases, debt, corporate. That tells you how risky your earnings are, how sensitive your profit is to small revenue. That's how you detect operating leverage risk. Watch margin trends, not just revenue growth. Revenue going up doesn't mean the business is getting stronger, but hey, is that operating margin expanding or contracting? A shrinking margin during growth often signals cost rigidity, poor pricing, or wage or commodity pressure. And look at the balance sheet for structural risk, scan for, in this case, lease obligations, working capital strain. That is how you assess downside resilience. So bottom line for accountants, when reviewing any kind of financial statements, just don't read the numbers, analyze the cost behavior and test the margin durability. and it reveals structural fragility. That's how you move from bookkeeping reading to true strategic financial analysis. Okay, and let's just try the Gemini infographic again. We'll click on Canvas. And you know what? We're going to try something a little different here. We're going to take all that context that we have, that we shared with the robot, and we're going to do something different. What you could do here is we'll put all that information in here, and then we'll go to the robot, and instead of just giving it a command, we'll say, brainstorm 10 ways this context could be dynamically visualized. And then rank them 1 to 10. Okay, so we're asking it to do, 3 things actually. Number 1, we're asking it to just look at that context, review it. And then number 2, come up with different visualization concepts. And then you say, okay, of all the ones that you've brainstormed, which one do you think offers the most optimal way to dynamically visualize that? So you're looking to it as a design partner. And here they'll have the elasticity seesaw and visual balance for profit sits on one side, a sunk cost sunburst map. They have a heat map here, flow through Sankey diagram. Isn't that interesting? But the point being here is you talk to the robot, just get their reviews on, hey, this is our context. What are the different ways that we could visualize this? And then let the robot come back with some insights. And here they'll say the elasticity seesaw. Okay. And I'll just say, okay, build that out. Build out the elasticity seesaw. And we'll click on that and we'll see what it comes up with here. So it should start coding right away. Yeah, there it is. But there's nothing stopping you. If you wanted to, you could build out, multiple versions of them and just compare and contrast them. But this is a very powerful technique, is that when you're talking to the robot, don't ask just for one answer, ask for multiple answers. Oh, that's cool. They have a real seesaw here. That's cool. I wasn't expecting that. So here's the Starbucks and I'll just the revenue volume. Oh, that's cool. Look at that. That's amazing. I wasn't expecting that. The verdict and the margin resilience on there. There you go. So there's something. So I wouldn't have thought of doing that at all. But when you throw it at the robot, you're able to come up with all these new ideas. Isn't that cool? That's funny. And you could share. People are going to remember that. They're going to say, hey, yeah, that instead of that line chart or bar chart, hey, we got, hey, Garrett sent me a seesaw. That's going to be impactful. There it is again. And we have the seesaw, the adjusted revenue volume. And they have the current, and then they have the roadmap, so they have these different cost structures that you can look at here. Anyways, isn't that cool? So that is the third part. That is the third capital efficiency element. We are on to dimension number 4. We're going to look at structural fragility. Right? Are you thinking about this as an accountant? Do you ask, what is the hidden weak link in the financial system? How would you do that? Well, let's explore it. First up, here's a prompt. I call it concentration and dependency risk mapping. So in this case, we're going to create a prompt, and we want it to act as a systemic risk analyst, evaluate customer concentration, supplier dependency, geographic exposure, and revenue reliance patterns, and quantify exposure concentration and assess diversification resilience. There we go. And here is the report that it generated, and we'll scroll through it and we'll ask the ChatGPT, just jump to the chase. Explain all this in plain English. So are they dependent on a few big customers? No. Starbucks, they got millions of people buy coffee every day. So what about your business? Do you rely on a few big customers? How dependent are you on one country? In the case of Starbucks, yes, about 3/4 of their revenue comes from North America. Are they dependent on certain suppliers? Yes, especially coffee and labor. How about you? Do they rely more on running stores or licensing? They mostly run their own stores. That means they carry labor risk, carry rent risk, and carry cost risk. Is the balance sheet safe? Yeah, they generate strong cash, but they also have billions in debt, lease obligations. That's not unusual, but if earnings fall sharply, flexibility tightens. Okay, so there's the analysis. But what does this mean for you and your business? Well, follow the concentration, not just revenue growth. Just don't stop at sales are up 6%, 10%. Hey, where's that revenue coming from? If around 80% of your revenue comes from one region, that's a concentration risk. If most revenue is company operated, not licensed, that operating risk is higher. So lesson, always identify what the company is dependent on. Growth without diversification can increase risk. Okay, margins tell you more than revenue. Revenue increased, but operating margin dropped. That tells you costs are rising faster than pricing power. So the lesson is margin compression is often the earliest warning sign of structural stress. Always analyze revenue and cost structure together. And then you have cash flow and fixed obligations determine survival. Net income fell sharply, but operating cash flow remained strong. So at the same time, debt, lease liabilities, ongoing dividends. So lesson in downturn analysis, cash flow coverage of fixed obligations matters more than EPS. Ask, can the business fund, cash flow coverage of fixed obligations? Can the business fund debt, leases, and dividends if earnings drop? So the meta lesson is good financial analysis is not just about reading numbers. It's about identifying dependencies, identifying sensitivities and downward exposure and downside exposure. Okay, good. Let's go to the second one. The margin decay early warning analysis. Here, we want to detect slow structural deterioration. Oh my goodness. So we ran the numbers by Starbucks for there, and of course, we do that for your company. And what does it say in plain English? Is that what the numbers really mean is revenue went up 5-6%, but their costs for coffee, labor went up. Operating margin fell from 12 to 9%. So even though they're selling more, they're keeping less profit. Think of it like last year they kept about 12 cents of profit. Now they're keeping about 9 cents, coming from rising labor costs, coffee, input prices are higher, pricing power looks softer. Is this a crisis? No, sales are positive, traffic is positive. So Starbucks is still growing, but it's getting more expensive to run the business. So the practical lessons for an accountant from this is, okay, revenue growth means nothing without margin discipline. Never celebrate revenue growth without checking whether margins improved, deteriorated, right? So compare your revenue growth percentage versus operating expense growth. If expenses grow faster than revenue, margin pressure. Always calculate operating margin trend year over year. So growth without margin stability is not high quality growth. Watch cost ratios, not just dollar increases, right? Raw dollar increases don't tell the story. The real insight is expense as a percentage of revenue. So convert every major expense line into a percentage of revenue. Compare year over year. Highlight any line that increases more than 100 basis points or 1%. That's where competitive pressure or inefficiency hides. And separate temporary noise from structural change. Good accountants don't overreact to one-time items, but they also don't ignore when trend shifts. Things like that are temporary, restructuring, transaction costs, tax anomalies. But structural are rising labor ratios, commodity cost pressure, weakening pricing power. So look at non-GAAP adjustments. Then ask, hey, even after removing noise, are margins improving or declining? If the core margin is still falling, that could mean it's a structural issue. So when you open any financial statement, ask, hey, is revenue growing? Are margins expanding or compressing? Are cost ratios drifting structurally? Okay, so if revenue is up but margin is down and cost ratios are up, competitive pressure or cost creep. If revenue is up and margin is up, pricing power and operating leverage. If revenue is down and margin is down, you got a demand problem. That's 80% of financial statement intelligence right there. Let's go to the third one in our structural fragility. And here we're going to look at the act as a credit structuring specialist. So we ran the numbers by Starbucks. And here we asked it to explain this in plain English. So on paper, Starbucks looks liquid. They got like over $3 billion in cash, ongoing revenue growth. So if you glance at this really quick, you say, yeah, they got cash. They're fine. That's the headline view, but not all cash is the same. Some of that money isn't truly free cash. You have gift cards and reward balances. They hold on to about $2 billion in stored value card liability. So that money is in their bank account, but owed to customers. So it's usable operationally, but it's not really extra money. It's more like a temporary float. They have the China assets are being moved around, so they're selling part of the China into a joint venture. So some assets are held, as classified as held for sale, and some accounting changes are temporarily improving margins. Right. So it makes the numbers look cleaner, but it doesn't magically create new cash. And they're also highly leveraged. Total debt, $16 billion, lease obligations, $9 billion. So the shareholders' equity is negative. So technically, they owe far more than they own on paper, but that's intentional. It's a capital structure choice. So Starbucks is run like, we generate steady cash, so we don't need a thick equity cushion. Okay, what are lessons from that accountants of all sizes in any sector can take from is that reported cash doesn't necessarily equal free cash. Don't stop at the cash line. Ask, how much is operational float? Is there gift cards? Is there deferred revenue? How much is restricted or tied to a transaction like assets held for sale? What is the minimum cash needed to run the business? So liquidity is about accessibility, not just a balance sheet number. Earnings can move, but cash flow tells the truth. Margins dropped, tax rate spiked, but operating cash flow is still strong. So the lesson is always reconcile income statement volatility to cash flow durability. Cash flow stability matters more than optics and credit analysis. And also leverage must include leases and structural obligations. Debt alone isn't the full picture. Add long-term debt, lease liabilities, dividend commitments, deferred revenue obligations. Could this company survive a 10 to 15% earnings hit? So true risk shows up when you layer fixed obligations against stress cash flow. So look past the headline numbers, follow the cash, and stress the obligations. Okay, let's go on to number 4 is our debt maturity clustering and refinancing cliff detection. Whoa. Okay, and we ran it by the numbers, and here's what they were in plain English. What's the situation? Starbucks got about $16 billion in total debt, and about 1.5 of that has to be paid or refinanced within the next year, and they got $3.4 billion in cash. So in short term, they're not in trouble. What is refinancing risk? Means when debt comes due, can a company borrow new money to replace it, and at what cost? So this is manageable in the next 12 months, but they could use some of their cash or refinance. Over the next few years, medium term, this is where things get more interesting. They got a lot of debt and have seen operating margins decline. But if interest rates stay high or go higher, that's when larger chunks of debt come due over the next few years. So it could cost them significantly more to refinance. Okay, what are the lessons from that? Is that don't just look at total debt. Look at when it's due. A company can have a lot of debt and still be safe, but what matters is how much is due within the next 12 months. Is there a maturity cliff coming? Is debt spread out over time or is it clustered? That timing drives refinancing risk more than the headline debt number. Liquidity covers maturities, right? Separate the analysis, cash plus operating cash flow. Can they handle upcoming principal? And you have EBIT and operating income. Can they comfortably pay interest? So liquidity solves short-term stress, but profitability protects long-term stability. And then stress test the future, not just the present. Ask, what happens if interest rates stay high? What if margins fall? What if credit markets tighten? Strong companies don't fail because of today's numbers. They fail when conditions changed and they weren't prepared. So it's not just about reading numbers, it's about testing resilience. Let's go to the 5th one, and that's the forecast drift. And here we're going to act as a behavioral finance analyst. compare multiple years of forecasts, identify systematic optimism, underestimation of risk, or reoccurring assumption errors, and assess whether strategic planning processes embed structural bias that increases fragility over time. Okay, and we ran the numbers, and then let's get to the explain it in plain English. Is that Starbucks told investors, yeah, sales should grow, margins should improve slightly. But in the first quarter of the year, sales did grow, margins fell sharply. Okay, what that means is the company's basically saying our strategy is working, sales are improving, but profitability will follow. But right now, profits are not following. Revenue is up, profit per dollar is revenue is down. That's the tension. So there's that optimism bias here, assuming margins will bounce back quickly, expect profits to recover even though costs are rising. And they're believing that their transformative or transformation investments will pay off fast. Is this reckless? No. It's steady, repeated optimism. And so far, the day-to-day sales are improving. So the point is that they're telling a growth story. The numbers are telling a cost pressure story. So there's, if the margins recover soon, the strategy looks smart. If they don't, the company becomes more financially sensitive over time. Well, the lesson from all this is that don't get distracted by revenue growth. Sales can be up while profits are weakening. Always ask, is margin expanding or contracting? If costs are rising faster than revenue, the business is getting weaker, even if headlines look strong. Okay, compare GAAP and non-GAAP, then SY. What's being excluded? Is this truly one time? Does this adjustment happen every year? And then study the balance sheet for fragility. Income statement show performance, balance sheets show resilience, look at debt levels, equity position, cash generation. So don't just read the story management tells, stress test the structure underneath it. Okay, there we go. So let's try that exercise again. Let's develop out a graphic for this, and I'll follow that same workflow. Just click on Canvas, and then we'll take all that context here that we got from the robot, and we'll put it in Gemini. Click on here. And then what we'll say here is, brainstorm 10 ways we could visualize this data and rank the most visually impactful, or just something like this. We're just saying, hey, come up with 10 ideas, and of those 10 ideas, which ones do you think would be the most engaging from a design or aesthetic perspective? From 1 to 10. And why? So here it's taking that context, it's reviewing it, and prioritizing these different visualization techniques, and it's ranking them. And then they'll have these, this is what it believes is the best way to visualize that set of context. And let's pick the first one, the expectation gap divergence bar chart. Okay, so I'll just say here, build out number 1. And it's thinking, and it's coding. That's just so incredible. I look at this and I go, before 2022, this would have been unimaginable, where you could say, you'd have to know, Python script and all this stuff. Look how quickly that it did that. So there's the sales narrative and there's the cost reality, comparing the guidance versus the actuals. So that's something that you can look at and be aware of. And, is there an expectation gap in your financial statements? There's the narrative that's told, and then there's the numbers behind it. And if you want, you could put that into a graphic like we did here. And this is what it would look like full screen. There it is, expectations gap, Gemini. And some of them, it could vary widely. Some have these interactive elements to them, others don't. They'll have different tabs, or they have that seesaw that we saw before. But the point of this, though, is, before, as an accountant, you would have to manually develop your graphics from scratch. Now you can just throw it at the robot. Just, hey, come up with 10 ways. Look at these data. What are 10 ways that we could explain this? And then brainstorm, and then rank, ask the robot to rank which it thinks is the most visually impressive or aesthetically or memorable, and then build it out from there. And that's how you can co-collaborate with the robot to elevate your accounting analysis. Let's now look at the fifth dimension in our framework, strategic optionality. Does this capital structure expand or restrict future opportunity? There we go. So let's look at the first one, the enterprise value sensitivity mapping, where in this case, we're going to act as a valuation advisory partner preparing for a potential exit or refinancing event, provide a valuation range, and highlight the most powerful levers for value uplift. Okay, so we got the robot to generate the output. And as I mentioned before, we don't have time now, but whenever you're running any of these prompts, you always want to do a fact check, right? To fact check, and then it'll come back. Some is true, some is accurate, some may be nuanced, and there may be some missing data that you have to plug in there, right? And another option too is you can take the whole thread and put it into Perplexity and say, hey, do a fact check on that as well. So do a lateral move. Do a fact check within that thread within ChatGPT, and then take it to Perplexity. And I should note as well that in this case, I'm using ChatGPT, but you still, if you wanted to, you could use these same prompts in any of these models. You could use it in ChatGPT. You could use it in Claude. You could use it in Gemini. You could use it in Grok. You could use it in Notebook. You could use it in Perplexity. You could use it in DeepSeek. You could use it in Manus. You could use it in Kimi. You could use it in Quim. So it's not just a ChatGPT thing. Okay, but we're back to the valuation advisory framework, and then the robot did its analysis, but let's just jump to the chase. Explain this in plain English. Think of the company like a house you might sell or refinance. It depends mostly on three things: how fast it grows, how much profit it keeps, and how risky lenders, investors think it is. And growth, how much sales increase every year. If it grows slowly, the company might be worth around 55 billion. If it grows strongly, it could be push its range up to 75 billion. So profit margins, how much of each dollar becomes profit, that's more powerful. Right now, the operating margin is around 10%. If it improves to 11, the value increases by 6 to 7. If it goes up to, let's say, 13, another big jump. Okay, so what does this mean in that perspective from an account? What lessons can we learn from that is that margins matter more than revenue headlines. Don't get distracted by sales growth alone. Ask, is operating margin expanding or shrinking? And a small margin change, even like less than a percent, can swing valuation by billions. Also, risk affects value as much as performance. Look at debt levels, interest coverage, tax volatility. Two companies with identical earnings can have very different values depending on perceived risk. And focus on sustainable drivers, not just one-time no's. Look at temporary tax effects, restructuring changes. True value comes from repeatable cash flow, not just accounting swings. That's how an accountant can think like a valuation advisor. Okay, good. Let's go to the second one in that dimension. And here we're looking at Exit Readiness Act as a private equity diligence advisor. Hold on here. Yeah. And we generated that response. And here is the outputs. And then what does that mean in plain English? Are the earnings real and reliable? Yes, mostly. Starbucks made money, but this quarter looked worse than normal because they paid restructuring costs, closed doors. They paid transaction costs related to China. There was one big one-time tax hit. Is the revenue stable and repeatable? Yes. They have over 41,000 stores globally. Sales increased 4%. Is the company financially stable? Sort of. They generate strong cash flow, but they got $15 billion in debt, $8 billion in lease obligations. So they're not broke, but they're carrying a heavy backpack. Okay. What's the lesson from that? Is that just don't look at earnings. Look at why they changed. the GAAP earnings dropped sharply, but most of that was driven by one-time items, restructuring costs. So always separate ongoing operating performance from one-time operating and accounting noise. Follow the cash, not just the income statement, profits payable, but the company still generated nearly $2 billion in operating cash flow. So cash flow often tells you more about the financial health than net income. Strong cash generation can support dividends and debt even when earnings look messy. And watch margins and leverage. That's where risk lives. Sales grew, customers increased, but margins compressed and debt is high. So when the meta lesson is when analyzing financial statements, revenue tells you demand, margin tell you discipline, and cash flow tells you durability, but balance sheet tells you risk. So train yourself to read all four together. And then you can transform yourself from being a report reader to this business analyst. Okay. Now let's put on the lens of a corporate financial strategist. We're going to evaluate unused borrowing capacity, asset monetization potential, and we're going to provide a financial flexibility profile with risk-adjusted recommendations. Okay, let's try that out. So we have the report that was generated. And what does all that mean in plain English? It means is that Starbucks is not in trouble, but it's not super flexible either. They have a lot of cash every year, but it also carries a lot of debt and long-term lease commitments. So technically, it's got a negative shareholder equity because of years of dividends and buybacks. So it's strong, but not loose. And does Starbucks have room to borrow more? Yes, but not a lot. They generate a lot of cash flow, and they already have about $16 billion in debt. So lenders would still lend, but they'll watch margins closely. Can they sell assets if needed? Yeah, and they're already doing it. They're selling majority stake in the China retail business to a partner that frees up cash, reduce risks. That's smart. Are they boxed in by loan restrictions? Probably not right now. They still produce strong cash, pay dividends consistently, but if margins keep shrinking, their cushion gets thinner. Could they raise equity? Technically, yes, but their earnings are down this quarter. Okay, so what lessons do we have from this? Is that don't stop at net income, follow the cash. We've talked about this before, but still, I need to reinforce that, is that always check the cash flow statement. A company can look weak on earnings, but still be financially solid if it generates real cash. So cash tells the story. Look beyond debt and see the full obligation picture. Starbucks doesn't just have traditional debt. It's got this huge lease commitments too. So always analyze total economic obligations. Debt, lease liabilities, off balance sheet or structured commitments. If you only look at bank debt, you could dramatically underestimate leverage. Separate temporary noise from structural risk. So the past quarter looked at, there was restructuring costs, margin pressure. Some of that is temporary, yes, but some may be structural. So is this one time? Is this recurring? Is this improving or deteriorating? So great analysis means distinguishing temporary accounting impacts from real long-term business risk. So when analyzing any kind of financial statements, follow cash, not just earnings. Analyze total leverage, not just reported debt, and separate short-term accounting from long-term business fundamentals. Okay, let's go to number 3. And that is, we're going to go our growth elasticity and capital scalability modeling dimension. Act as a strategic expansion advisor and assess whether the company can scale without disproportionate capital infusion. And there, the robot created the output, and let's just see it all explained in plain English down here. So Starbucks is growing, sales went up 6%. More people are coming in, it's good, but the sales went up, profits went down because of the rising costs. And they also pay dividends, carry long-term debt, have negative shareholder equity. So what that means is that they're selling more coffee, but more customers come in. It sounds good, but their costs are rising faster than their sales, and that's not so good. So what is that lesson from that? Revenue growth means nothing without margin analysis. Cash flow tells the real story, and that balance sheet structure determines fragility. They carry $15 billion in long-term debt, have negative equity. So the lesson is strong cash flow can support leverage, but margin compression makes leverage riskier. Don't analyze financial statements vertically, which is like one statement at a time. You have to analyze them diagonally, revenue, margin, cash flow, debt risk. That's how you see whether growth builds value or builds fragility. Okay, another one is we're going to look at this strategic scenario tree and decision path analysis. So act as a strategic finance architect, construct a scenario tree incorporating different variables, and provide recommended strategic decision triggers under each path. Okay, again, it's a prompt you can run on your own. And we did the analysis, as you could do with your analysis here, and it comes back with all these decisions and trigger matrices and finance architects' conclusions. But in plain English, is that this whole scenario tree means that Starbucks is doing really fine right now, but it's walking a narrow edge. Sales are growing, more people are coming in, but not because prices are rising, but ticket growth is only about 1%, which means that they don't have unlimited pricing power. Transactions are the real engine right now. So the future depends on four big things. Can they keep customers coming in? Can they raise prices without scaring people away? What happens to interest rates? What happens to the broader economy? And here is the simple version of these four possible scenarios. Most likely, 45 is the economy is okay, people keep spending, and Starbucks grows slowly but steadily, and margins recover a bit. That's the boring but healthy path. The next is the cost squeeze, a 25% chance, where coffee stays expensive, inflation sticks around. Sales grow a little bit, and they tread water. They have the recession scenario, where 20% chance, where people pull back on their spending, fewer visits, debt becomes more noticeable. That's the real danger scenario. And then the strong upside, 10%, the economy improves, rates fall, customers show up more often, profits expand fast because Starbucks has strong operating leverage, stock does well. So the biggest risk is not pricing. In this case, it's transactions. How many people walk through that door? What lessons does that provide for accounts? Is that revenue quality does not equal or is not necessarily better than revenue growth. Just don't ask are sales up, ask why. Where is it coming from? Small margin moves matter a lot. Operating margin drop 12.9 to 12.9%. Looks small, but it crushed earnings. So a few hundred basis points in margin change can swing the earnings per share dramatically. So margins tell you how fragile or resilient the model really is. And balance sheet risk amplifies income statement volatility. Always connect profit trends, debt levels, interest rate exposure, and financial, because financial statements don't exist in isolation. Cash flow and leverage determine how much stress the company can survive. So in short, understand the engine, the revenue mix, respect the leverage, the margins, and assess the shock absorbers, the balance sheet. That's a higher next level of statement analysis. Okay, now let's go to the end. Let's kind of wrap this all up, and we'll have the financial intelligence engine. So what this does, it just takes all those prompts that we had and puts them under one master prompt, where you're going to act as a senior financial strategist, and you look at earnings truth, liquidity and survival, capital efficiency, structural fragility, and strategic optionality. And then from that, deliver a executive summary board-ready deck, where you're looking at strengths and vulnerabilities, risk rating profile, and present findings in a structured executive format there. Why it works, it promotes multidimensional thinking, it prevents this ratio tunnel vision, and elevates the conversation. Okay, I'm just going to close that window here. So here is that master prompt, right? So you have a couple of options here I've laid out in this framework. Number one is that you can go through each of those 5 areas, and you can pick one or all of them and select whichever prompts in each one of them, and you don't have to follow any particular order. You can just customize. It's like a buffet and pick whatever you want. Or you could start or finish with this master prompt, where you get all 5 signals, all 5 perspectives in one prompt. And here is that executive summary, but we'll want to get the explain in plain English here. And there it is. So what's going on at Starbucks? Starbucks sales, they're improving, but profits are under pressure. They're getting more customers back into stores. The good news, sales are up 6%. Not so good news is that the profits are dropping significantly. So are they in trouble? No. What really matters now is the next few quarters will tell them everything if traffic keeps growing. So what does this all mean? Again, revenue growth does not equal profit quality. Sales were up, traffic improved, margins fell sharply. Lesson, never stop at revenue growth. Always ask, where's the growth coming from? Cash flow tells a different story than net income. always reconcile earnings to cash, and the balance sheet reveals structural risk. It's got high debt, large lease obligations, negative shareholder value. So when analyzing financials, always look through three lenses: performance, the income statement, cash reality, cash flow, and the structural risk, which is a balance sheet. Miss one and you miss the truth. And just one final thing I want to point out in this last piece here is that if you use that prompt, you're going to get this this executive summary. So if you're looking just to say, if you only pick one of this entire framework that we picked, and you're looking for a output that you could share with your colleagues or peers or staff or board or decision makers or whoever, this is it. Because following that prompt, you get that board-ready executive summary. And they have the different lenses, the earnings truth, the liquidity and survival, capital efficiency, structural fragility, strategic optionality on here. Okay, and we'll wrap it up with how would you visualize this? Okay, so what we'll do is we will take the whole thread here and we'll copy and paste it. So I'm going to take the whole thing up here. Hold on here. And there we go. Excellent. And we're going to go to Gemini, and we're going to do what we did before. We're going to put that in Gemini. We're going to select Canvas, and then put that there. And then we'll just say, brainstorm. Hold on here. Brainstorm 10 ways this context could be dynamically visualized. Rank 1 to 10 with just greatest aesthetic. Hold on here. Aesthetic. I can't spell it here. And, design appeal. You get the gist of it. Just saying, hey, here's all the different options that we have, but what do you think would look the best? And it's visualizing the strategic context, developing these different concepts, and fascinating data set. Okay, and here they'll have the growth matrix, the interest coverage safe zone gauge, animated margin erosion waterfall. That's interesting. Or the kinetic solvency simulation, which is most effective. What does it say here? I would recommend, depends, right, who you're talking to. For a board, I would recommend a combination of number 4, waterfall, for immediate tactical clarity, number 1, kinetic solvency, to communicate the highest structure value. And would you like me to build a functional version of these, such as the interest? Yeah, let's just, build out number 1. Build out number 1 is the kinetic solvency simulation. Okay, we got Canvas selected. Click on that. And it's building it out here. And it'll feature a physics engine, a weight of debt, a fluidity of cash, and interactive stress testing. Well, hopefully that won't take too long. But yeah, so that spells out exactly what approach that they will take. And as I mentioned before, is that is it that quick already? Okay, we get that seesaw thing again here. Okay, is this something went wrong? Okay, and that's okay. Sometimes the robots will not figure out. Maybe it gets too ambitious. I'll click on Fix Error. Right, so if it doesn't work the first time, don't panic. That's the norm. Often they'll have a pop-up message saying, hey, can we redo it? And we'll try it again here. I made some changes, and it's updating here in the upper left-hand corner and ensuring the custom code for the perspective and slider thumbs is handled correctly. Okay. And for whatever reason, if it doesn't work, that's fine. No problem. There it is. And stable equilibrium here. The core inflation. Okay, there we go. There it is. The labor investment, the global revenue growth. So here's that liability base. Isn't that interesting? Yeah. So you can reset that stable equilibrium. But if coffee was to go up, it would at 50. They have these gradients here. But again, very interactive on here, colorful. And here also too, if you don't like the black background, you could say make this with a light theme, and more images and icons. We'll see if that works there. So it's updating that. So you want these aesthetic shifts. You want to come back with a more different palette. And here they'll have they want to use that coffee cream palette of Starbucks, but they're going to have this rich iconography there. So again, you're in control. That's the great thing about the robot, just knowing how to talk to it all the time. And you'll get these different variables listed here. And this is one. But there was 9 others that you could select as well. So there's ones that when you see them written, you think, oh yeah, it looks good. But when you see it actually generated, you go, well, maybe it's not what I expected. And here we go. There we go. We have that change, and we went from that dark background to a light background. Okay. And we can click on that. But again, people love that. This is something that's memorable. Action, movement. All these are ways that can elevate your advanced financial analysis when looking at, and here we're just looking at Starbucks as a case study, but you could play your data or any company that you want to elevate your financial conversation. Okay, time to wrap it up. What do you know now that we didn't know before? Number one is the meta shift. The whole point of this presentation, the whole point of this framework is I want to propose a new form of financial analysis in this AI age we're in. It's this structured multi-lens interrogation system. It's not just looking at ratios. It's triangulation-based workflow and AI-augmented pattern recognition. Judgment amplified by machine cognition. The future trusted advisor will not compete just on spreadsheets and ratios. They're going to compete on this structured AI-enhanced financial intelligence. Okay. Number one, cash is king. AI enables rapid triangulation. So cash flow remains the ultimate truth serum. Net income, non-GAAP metrics could be flattered by accounting mechanics, but operating cash flow reveals whether profits are real, sustainable, and liquid. And AI elevates this discipline by enabling instant reconciliation across statements and periods. Instead of reviewing statements sequentially, accountants can now integrate them diagonally: income, cash, obligation, survival. The shift is from static review to dynamic triangulation. AI accelerates detection of liquidity illusion, working capital drag, and structural solvency risk. Number two, you want to separate the signal from the noise. AI accelerates pattern recognition. The whole point of the framework is to isolate durable economic performance from accounting noise. Normalize earnings, distinguish structural from temporary drivers, test narrative against numbers. AI enhances pattern recognition at scale. It can surface recurring one-time items, margin decay trends, and add back creep in minutes. So the accountant role shifts from data processor to signal interpreter. And AI increases cognitive bandwidth. Judgment becomes the differentiator. And just finally, too, margins and structure drive value. AI enables multi-dimensional thinking. So revenue is motion, margins are strength. The balance sheet determines survivability. And this framework prioritizes margin durability, cost elasticity, and structural fragility over revenue headlines. And AI transforms linear analysis into integrated modeling, connecting revenue, margin, cash, capital, risk, and optionality within a single workflow. This is a new cognitive operating model. In the AI era, accountants prosper not by calculating faster, but by orchestrating insight across dimensions. To recap our presentation, we had an introduction, and then we looked at the 5 dimensions: earnings truth, liquidity and survival, capital efficiency, structural fragility, and strategic optionality. And then we ended up with that financial intelligence engine, which gathered and synthesized all those different elements into one master prompt. And then we had the key takeaways. This is Garrett Wozni saying thank you so much for attending today. I really appreciate that. And this has been ChatGPT and Advanced Financial Analysis for Accountants.